Good afternoon, everybody. Thanks for joining for our Lunch and Grow Meetup, Friday Meetup. We try to have meetup every other Fridays and try to bring some awesome guests who just bring tons of knowledge on multifamily syndications, due diligence. I think we have that today. My name is Vinky Loomba. My focus is multifamily investing, and I love to help people find the great deals that they can invest in and grow their wealth passively and have their money work for them. So today our topic is broker's opinion of value, and today our special guest is Shumul Siegel. I hope I said your name right. Shumul Siegel is a CRE broker, commercial real estate broker, working at CSN Commercial. He's a certified investment real estate and due diligence specialist with special expertise in retail sector. And today, Shumul will share a broker's view of capitalization approach, comparable approach, and replacement value approach. We'll also get some insight on legal, financial, physical aspect of due diligence. Today's meetup is something like more like experiential meetup, right, Shumul? That's what he was saying, that he's gonna give us some real life experience. We'll have some fun, interactive, creative deal making, and we'll also get to solve some complicated deal breaker questions with him. Brand new experience for us, right, Shumul? That's what you were planning on?
That's what we're planning on. We're going to start with the due diligence. So we'll swallow the frog first. Then we'll move on to some creative deal making because it's so much fun. And if we have time, we'll go through the BOV, the broker's opinion of value. So
wow, that's super awesome. But before we get started, let me do a small little disclaimer. This session is strictly for educational purposes only. And we're not trying to sell anything or any kind of solicitation of an offer for any investment or securities. So please use your CPAs, financial advisors for any investments or any tax specific situations. So that's it. And I would like to welcome you, Shumul. So stage is all yours.
Awesome. Well, I prepared a presentation, so I will share my screen. Share. Okay, can you see this right here with the Loomba logo as well?
Yes, I like it.
Yeah. So this is out of appreciation for having me. You gotta respect the representation. So I'm looking, if you see me looking this way, it's because I have two screens. So how do you do the presentation? I think it's F5, right? Like this, that's a shortcut. There we go. Okay, we're good to go. Mm-hmm. So let's, like you did a disclaimer. I have one too, but we could just skip it. And just for the hell of it, some more notes and disclaimers. But we can skip that too, since we already spoke that this is in no way me giving you any specific tax consultation, legal, and does not make any broker agent relationship. This is strictly for educational purposes only. Okay, so managing expectations, always important. Due diligence and deal making is huge. I will try to focus on very specific points when it comes to due diligence. I will hope to teach each one of you at least one thing that you did not know. If I accomplish that, please let me know. I am a retail specialist. Most of the deals that we do in CSN Commercial is retail focused, but I will keep this multifamily focused since I believe this is what the majority of people are doing here, except Masha, who is concentrated on something else. Storage facilities. There we go. I got it. So please share your own experience, whatever you know and whatever you can add. Always fun. And please reach out to me if you want any more detailed information. That said, we can go ahead. So when it comes to due diligence, since it's such a huge topic, I like to kind of segregate it into three major sections: the financial, the legal, and the physical. And as we go through it, I will do the same. And we will start with the legal just because it's so mouth crunching, sometimes annoying, difficult, and fun. But before that, the importance of due diligence, which we should all remember. A property can go down in value the day ownership is conveyed. And I don't want you guys getting a cat in the sack. Know what you're getting into, know what you are paying for, and know what you should not pay for. And you can do that by doing proper due diligence. So far, so good?
Yes.
Perfect. Okay. So before even going into due diligence, before even having a PSA agreement and having all the contingencies and having to waive them, you should definitely get as much information on the property as possible. Now, this isn't always possible, but in every scenario, you should try and get the recent third-party reports. When I say third-party, anybody that the landlord is using as a third party for the property. So management reports, service contracts, which I have it in its own section itself. It's really helpful to understand from other people what's happening with the property. Third party can also be previous environmental reports, atlas surveys, etc. Whatever is available, you should get your hands on it. Past operating expense statements, you should always review ahead of time. Because if you actually see the past operating expenses and you see it doesn't even match the OM, you should say, hey, this is not a property I'm interested in. Instead of wasting a whole lot of money on legal fees, putting together a PSA agreement, sending it over, getting all this information and saying, this is just not relevant to me, save that time, save those expenses, and get that information as soon as possible. I also recommend seeing service contract agreements, leases and operating statements, and tenant files and correspondence. Long shot that they will give them to you, but you should always ask. It doesn't hurt. If the landlord is not giving you even a little bit of information, depending on your track record, which is important to think about, if this is the first deal you've ever done, nobody knows you in the market, you might get a little bit of hate. If you've done a lot of deals and the landlord is not kind of cooperating, that could be a red flag. So watch out for that. When it comes to the legal due diligence, some advice. So always have a PSA ready to go. And the reason is, if you have a very competitive market like we do today, and you put together an LOI and you send it over, an LOI is a non-binding agreement. You're basically saying, these are the business terms under which we want to go into a sales agreement with the owner. If everybody is sending an LOI in a competitive market and you're just sending a ready to go PSA agreement, all the owner needs to do is sign and you're ready to go into contract, that could be a competitive edge for you. And if it looks good and the landlord is just ready to accept it, that could give you an edge on the market. So always have a PSA. I'm not saying always use it, but have one ready to go in case you just want to send that over and say, hey, I have the first bid, I have the first ask. I am the first one to show that I'm serious about this property. I'm ready to make this acquisition. When you have PSAs and LOIs, always important to have expiration dates on them. An expiration date to accept the offer, an expiration date to go under contract if an LOI is accepted. The reason it's important is because you can send an LOI and then you're not going to get a response. Then you send another LOI for another property. Simultaneously, a month later, they can accept your offer. And now you're kind of in this uncomfortable situation saying, yeah, well, I already closed on something else. And they can say, yeah, but why didn't you retract your offer or say anything? So to avoid those and kind of giving a timeline into when you should expect to receive an answer, always have that in place. And it doesn't cost you any extra money. Just this contract will expire, this offer will expire at this or this date, consult your attorneys. Always verify what proper notice in the PSA means. And when I say proper notice, when you waive contingencies, there is a clause in each PSA that should say a proper notice. And the proper notice could be by email. Proper notice could be by the owner. Proper notice could be very specific. And you want to have that as broad as possible, because if you want to send proper notice through a broker, proper notice through your attorney, proper notice through email, through letter, through phone call, whatever it may be, it needs to be said. Because if you don't have that in place and the landlord wants to give you a difficult time, you can say, hey, I didn't get your waiving of contingencies. or I didn't get your proper notice of not wanting to continue the deal because you said it on a phone call and this was not properly sent email, just like it would say in the PSA. Do you guys know what an estoppel letter is before speaking about that? Okay. In case somebody does not know what an estoppel letter is, because I did a presentation once and not a lot of people knew what they were. It's basically you're giving a tenant a letter asking him to verify the information on the lease. You're saying it says in the lease that you need to give this amount of a security deposit. It says in the operating statements that this is the amount of money you're paying for rent. Is this true? And then the tenant can say yes or no. Sometimes landlords can be really about it. Sometimes they're cooperative. That's why you should never make it a requirement, make it a contingency. That way, if the seller will then be more diligent, and if the tenant doesn't agree, it won't tear apart the deal. So just some good advice. You should have a clause in the PSA saying that in the contract, the seller has the option of paying off existing monetary encumbrances from the proceeds of sale, giving them the ability to convey ownership. Because if the landlord is not able to use the proceeds of sale to pay off encumbrances to actually have the ability to give you back the property, you could have a problem with the conveyance sometimes. So again, consult with your attorneys, but make sure that this clause is or is not needed depending on your situation. Also, and this actually happened to me, make sure the corporation or the LLC gives or has the right to convey ownership. I worked with a vice president on a deal that was selling a property, and at the same time, the president was doing another deal. And he didn't even have the right to sell the property. He just kind of took it on himself. So you should always have a letter saying, or usually today contracts come with it, but always make sure that the person you're doing the deal with has the right to convey ownership to the property. Maybe he's just one partner and there's three of them, and the LLC in its entirety needs to agree on that. He might not have the right to sell it, and it might be just a big waste of time. Maybe he's just testing the waters and he's testing it on you. You don't want to waste your time. So legal stuff continued, and this will be the last page of legal. And again, this is not legal advice. This is just stuff from my experience. I'm not an attorney. I can't give you legal counsel, but I can tell you from my experience stuff that I've used and believe you should have in place. So insurances need to be in effect as of the closing date. Because if you don't have that in effect as of the closing date, and on the closing date something happens, you could be in trouble. So make sure you always have that overlap of insurances. Very super important. Security deposits to be transferred. Make sure you have that figured out, how you want to transfer the security deposits. If you want to transfer from one bank account to the other, if they want to convey over the bank account, whatever you decide to do, make sure it's discussed. This is only relevant in some states, but sometimes a new landlord cannot recover rent unless they first send adequate and timely notice to the tenants to pay up. Landlord needs to send this in order to make the rents that were not paid to be uncovered by the new landlord. Because if it does not give, in certain states, make sure you qualify or not, but ask your attorney about that. If he does not give adequate and timely notice about the outstanding rents, you might not be able to uncover that. And that could be kind of a hit sometimes, especially in some markets and in some deals. So this should be in the leases. You need to make sure it's negotiated. And if not, have a clause in the agreement that over the top electrical usage by a tenant at landlord's expense. You don't want that. We want to be able to cap that and have the ability to bill back after a certain amount of usage. If the leases say tenants can use as much as electricity as possible, you should go check out the property, go there at night, go there around the clock, see what these expenses look like. And if they're taking advantage of that, maybe that's not a deal you want to get into, because electricity, and we know now in inflation, it is, and then we have an inflationary market, I mean, electricity bills are going up, so watch out for that. Review the leases, please. Review them, hire someone to review them, get a third party to put lease abstracts together, but look at those leases, because those leases are the building blocks of what give you the cash flow to your property. You need to know what's in there. You need to review them. Also, make sure to get a certain provisions built into the PSA that can get credit back for certain leases when it's proper. So you want to make sure that if something is not, built correctly, and the landlord didn't do a good job, he's given out rent abatements way too much, security deposits are not fitting to what they should be paying, you should be getting, or forgiveness of rent, you should be getting a credit back for those agreements that the landlord decided to do. You don't need to take on that risk. And the last, not least, bait and switch. And this actually happened to one of my clients. Bait and switch means that when you come and sign the contract, and this happened to me on a lease that we did in it was a restaurant lease in Chicago, and I spoke with my client, and he asked me if it's possible that the landlord would switch up the leases. And I said, it's possible, it's called bait and switch, but it does not really happen, so I would not be concerned. And guess what? It happened to him. So always make sure that this is the lease that you negotiated. This is what you were talking about. Don't sign on something that you did not read. Don't build on that trust of, or the euphoria of, oh yeah, it's okay, it's good, we worked on this. Bad things can happen to good people. This was an example of it. Going into the financial due diligence that we need to do, just a few ideas of stuff that you can pay attention to. Make sure the proration of rent reflects the actual rent and campaign, and not just the scheduled rent. So if there's a scheduled rent of a certain amount, make sure that you're actually getting prorations of the actual rent, or giving away. Now, this could be to your benefit or detriment, depending if you're on the seller or on the buyer side, but watch out for that. Appraisal that you are going to hire, this is an obvious one, but always important to remind everyone, make sure he's on the approved list of the lender that you are planning to use. Check to see if interest calculation is 360 days or 365-day period. That could be extremely important, especially with 20-year amortization. Sometimes lenders kind of play with those numbers, and if it's 365 days, you're probably going to be paying more interest than 360, or vice versa, depending on the deal that you have. Do not let the appraiser process go on autopilot. And this is a very big one. Oftentimes we get an appraiser because we're getting a loan, we send him over, he kind of does what he needs to do, it goes on autopilot, he comes back and says, okay, this is what I have. It's much better to control the process and give those appraisers as much information necessary as possible so that they can make the property more profitable. Speak to them about upcoming leases. Maybe you're buying the property and you've already discussed with a bunch of tenants to come in. Leases that will roll over and that you know that. Value add ideas, lower management or operational costs that you guys plan to do, and of course comparables. Hand that over to them. It could be super beneficial. I'm not going to go through this whole list, don't worry. Just make sure that all service agreements have cancellation provisions. If they don't, let the seller know that he is in charge of termination fees if you as a buyer can rebid and get better pricing. And these are just possible service contracts that you can have in a multifamily building. And again, if a landlord negotiated a service contract for the next 10 years and he has a cancellation provision where you would have to pay money, you do not have to pay that fee because the landlord did a bad deal. He needs to credit back that money or figure something out. I think that's very important. So going to the final and funnest due diligence category, the physical due diligence, make sure you get the copies of all the warranties so that you're aware of them. When I say warranty, I mean elevator warranty, fire hydrants, air conditioning, roof warranty. You need to look at those warranties and understand how long they're for, what they give you. You need to have those copies. It's very important to have that in your file cabinet. Make sure there's a list of the inventory that you're getting, and that list is in the PSA. Also, schedule a walkthrough before the close so that you can see that everything is there. Also, make sure to take pictures of the inventory beforehand. A landlord can say, yes, every single unit comes with a refrigerator, with an oven, and with a washing machine. Then you'll do a walkthrough the day before, and all of a sudden half the furniture is gone. Make sure it's there. Also find out, this is not relevant always, but if you need a bill of sale for the actual tangible property that's inside the multifamily building. Again, discuss this with a tax attorney, discuss with an attorney. Not always needed, sometimes is, make sure. I also recommend to walk every single unit. You might be surprised what you find out. A landlord could be selling you 50 units and you walk all 50 and you all of a sudden realize that he combined 3 of them because the tenants wanted to have a bigger space. So he broke down the wall. You might find out that and this happened, the landlord is using one of the units as storage facility for himself and his own stuff. And then you say to him, okay, when are you gonna empty this out? He says, oh, I'll give it time. You need to have that in the PSA, that unit number of this and this and that. Landlord needs to make sure he delivers this empty and clean by the closing date. If you don't walk all the units and you just say, okay, let's do half of it and that's it, you're missing out and you can find out some pretty annoying things. Also explain any items to the lender that can be delayed in repair or replacement so that they won't require holdback of funds. Lender can say, okay, we did the full valuation, we did an appraisal report, and we have somebody coming in and making sure what the property looks like. You need a new roof. We're going to hold back a part of the loan so that we can pay for that as a CapEx. You might say, listen, we can delay this in a little bit. You don't need to hold this back because any funds the loan is holding back, you're missing that. You either need to complete it as equity or get a mezzanine loan. Make sure to ask third-party inspectors to call you right after the inspection. They should relate to what they found while it's still fresh in their minds. And this is super important because if you wait and they don't have it fresh in their head, what they saw, what the property looked like, you might be missing out on some information. This is critical information for you because you're buying this property. He might see something really, really small or just think of something. When it's fresh in his mind, make sure you give him a call and he gives you that information. Okay, reflections. Any questions on the due diligence part? Did you all fall asleep?
I'm sorry, I was talking on mute. No, we are still here. Anybody has any questions? I think this was pretty extensive. I mean,
Yeah.
I always think that leasing is gonna be the really big one, like you go through all the leasing is like a lot of paper trail maybe too. So how exactly that happens? Do you look at each and every lease that was signed, or how does that work? Do they have kind of like a soft copies, or any way they are tracking it better? Do you have anything in your experience like that?
In my experience, I've worked, so it really depends on the owner. If he's a good owner and also institutional owners, usually they have a very specific lease template and it's exactly the same. So you know exactly the page number because you don't need to get every single clause. You need to get the most important clauses, and that's what it's called, a lease abstract. You can pay a company and they take all of the leases and they prepare a lease abstract and they can give you a spreadsheet saying, okay, this is what each tenant is actually paying according to the lease. This is the security deposit. This is the lease term. And this gives you the most important parts of it. I mean, obviously, the more units you're buying, the more complicated it gets. And the better the management company or the owner and the better he handles his leases, the easier it gets. I've seen situations where each lease is different. And yes, you have to go through every single one because, again, if you find out that one of the tenants has 5 options to renew his lease with under market rates without any rent increases, I mean, that's a bad deal, and you should get a credit back for that, for the very least, because you're losing out a lot of money. So super important to pay attention to those leases and see what's in there. And again, it really does depend, but that's my recommendation. Did I answer your question?
Yes. Yeah, it did. I think Jim has a question too, seems like.
I was just curious about the estoppel letters. I find that in bigger deals, it's very unusual for people to ask for them. And was wondering if you had any input on that.
I think when it gets to those bigger deals, you're working with a very serious management company. When you see that everything is in place, everything looks good, everything is by the book, everything is available to you, the books are just incredibly well done, everything is well placed, then yeah, sometimes you could just say, you can tell that you're working with somebody serious. On the smaller deals, when you're working with someone and the books are just all over the place, then yeah, I would want to go and speak to the tenants and understand what's actually going behind the scenes. And oftentimes those, odd, distressed, off-market value-add properties, I would certainly go ahead and look at those estoppel letters and even have tenant interviews and say, hey, what's going on with this property? I mean, I've seen some terrible looking properties, and I couldn't imagine why a tenant would live there, especially with the rents that he's saying that he's asking. So, and you want to really make sure. I guess it is always a case by case basis, but estoppel letters, you don't have to ask every single one. Also, you can also ask specific tenants. You can really play with it, but yeah. Okay, any more questions?
I think Masha has one. Masha's hand is raised.
Oh yeah, please. Masha, how are you doing?
Doing good, doing good. I'm actually so excited I got here. It was very valuable what you shared. Really, like, thank you for all these points. I truly got value from it. Thank you.
Happy.
And yes, thank you. So I have actually questions. So I heard how some investors have the strategy to win the deal. They go straight forward and put the contract, right? So my first question is, I know that in different states, and I'm not investing in one state, right? With self-storage, we're kind of looking at it's different a bit strategy. So I can go with the same contract to all the different states, because usually you obviously hire a lawyer from that state, and then you so how does it work? Do you know by any chance? How could it work?
I think that's definitely more of a legal question. It is like a broker question, but I do know that each state has its own real estate laws and clauses and different, different little, what's the word I'm looking for? Jim, help me out here. Like
Nuances?
Yeah, nuances. There you go. So definitely consult with your attorney. I think also usually real estate attorneys who do work with investors, they realize the slight differences. It's why it's also good to work with a broker in each state, because they should know the rules, so they can save you a lot of legal fees, but just by saying to you, or even giving you a sample PSA and say, hey, this is what I use. This is what you can use as well. Oftentimes PSA agreements, they're very templated. Sometimes when you have the bigger deals, you want to have it suited to your specific needs. But I mean, when you have a real estate team to work with, and you work with a broker and you work with a lawyer, they can give you a lot of insight. Does that make sense? Okay, I think Masha froze.
Frozen.
Yeah. Okay, we'll go on to the fun part, and I will start with the golden rules for creative deal making, and we'll start with being creative makes this business fun, and it truly does. When you're creative and you're thinking of just creative ways to do things, it is a lot of fun. You gotta listen a lot, kind of like what you guys are doing now. Listen more than you talk, because when you let the other person talk and say what he needs and their expectations, you can really understand what they want out of the deal, and you can really get a good deal done. Don't be afraid to brainstorm with the other party as well. They're not your enemy. You both want to get a deal done. If you feel like the other side is an enemy, don't do a deal with them, honestly, because when everything is fishy, and again, you might get a cat in the sack, and when you feel like the other side is just trying to screw you over, as good as the deal is, I think the loss over value is just completely outweighed when you work with somebody really, really sketchy who you're not really comfortable with working. Ask questions to relieve pressure. That always helps when you see like the deal is kind of boiling up. Asking questions can really help a lot. How are you feeling about this deal? What's going on with you? How is this property? What kind of questions do you have for me? What's going on with you? Questions really help that. Always be adding value to all sides, and have a negotiating story. This is like the most classic negotiation story. So I love it. I always share it. There was a dad, he saw his two daughters fighting over an orange. So they're fighting, she wants this, he wants that, classic negotiation technique. He takes the orange, cuts it in half, gives one daughter one half, gives the other one the other half, and he sends them their separate ways. An hour later, the dad goes and visits one daughter, and he says, hey, what are you doing with the orange? And she's making orange juice. He then goes to the other daughter and says, hey, what are you doing with the orange? And she's using the peels to make jelly. All he needed to do was ask, what do you want from the orange? One would have said, I want the peels. The other said, I want the inside, just to make orange juice, and they would not be fighting. So understanding the situation, speaking about it, asking the right questions, and brainstorming can save you a lot of frustration and a lot of time, and can get you a great deal at the same time. So we're going to start with the first scenario, and these are all scenarios I kind of had to deal with. So guess what this guy is? He's not a broker. It's not me. It's an appraiser. And the lender approved 70% LTV for the agreed upon $15 million acquisition of a multifamily property. So far, so good? So far, so good. The appraiser, this guy, per the bank's request, valued the property at $13.5 million, 10% short of the agreed upon price. Uh-oh. What do we do? The problem, loan will not cover the outstanding amount to cover the full acquisition. What do you do? Any ideas? Now, I know what I did, but what would you guys do?
I would ask to see a detailed report and see if the bank would share that with me, and make sure and compare the underwriting that I have on the deal to the underwriting that the bank is using from the appraiser, especially things like comparative rents.
So checking back and looking at it. Now, I'll be very difficult with you because it was difficult with me. They're not going to change it. This is the appraised value. That's what they think it's valued at. Now, with your underwriting, it's $15 million. You want to do it for $15 million. You don't have a problem with the acquisition price. The problem is just with the lender at 70% LTV.
Go to next lender.
Next lender. Okay, that could work. Any other ideas?
There's going to be a breakup fee.
So what we did was something really, really interesting. We did this. If buyer is low on equity or discrepancy in the loan amount, seller can hold a 10% second mortgage. Seller financing does not have to be for the full amount. It does not have to be the first mortgage. It could be a junior mortgage, and it worked well. He was okay with that deal. Plus, he got interest payments as well, so it was a win-win situation. Another idea that you can do is actually, depending on the situation, ask for a price deduction of the property and give the owner 10%, the same as an LP in the property itself. Just using that same amount of money, but changing it over as an LP. So that way he's getting actual residual income from his own property, and he knows it's a good property, so he's happy with that. In certain situations, and again, in certain situations that can also work, but just ways to think outside the box. Okay, you guys like that? Next. So this is happening. Do you know why this is happening? Because the buyer is saying pro forma rents seem to be completely unreasonable. Rent absorption forecasts are crap, and the price per its future valuation is completely unreasonable. And that happens usually when brokers are involved and they have like a very nice pro forma, but it does not really work with what we're seeing in the field. And the seller is saying this is a great property in a great location. The upside is there. The price is justified. You're in the middle of the PSA agreement. You're almost closing, but then this comes up because you want a deduction on the price. What do you guys do?
Move on.
Move on. Okay, that's good. You like this deal. You don't want to move on. This is a great deal. You just need a little bit of a deduction on the price. I mean, that's it. But he's not giving it to you. You have a deadlock. It kind of looks like this picture, right?
What if you find something wrong with the property? Like you can say the foundation or some other problem that you found with the property that.
Nothing wrong with the property.
Maybe add a
contingency
on performance to that starts reaching the seller's pro forma per se. So if they're really adamant that the rents will be reach those numbers, then maybe some kind of agreement that justifies, a split or something.
Jeff, you're a genius. That's exactly what we did. So those 3 ways to do it. Well, I didn't mention the problem, the discrepancy between buyer and seller, but that's exactly what we did. You can either carve out income for the seller to negotiated units. So if he's saying that you have a 10% vacancy and the seller is saying they're going to be full and the buyer is saying they're not going to be full, you can carve out those specific rents in the agreement and give the owner that income in exchange for the deduction of the price. And it could be for the lifetime of the ownership of the property, including some other deal if you sell it. Another way of doing it is you make an escrow for the amount, for like the discrepancy amount of what you think it would cost. If those units become occupied, the buyer pays the seller from that escrow, and this is like an individual escrow account. And if they stay vacant, then the seller will pay that back to the buyer. And you'd need to see like the time frame of how you would do that. You can also do it in installations over a period of time. A third way of doing it is you have an escrow account for that vacancy. That escrow pays the rent until space is occupied. So you use that money to pay back those rents until they're occupied, and then once they're all occupied, you release that money and send it back to the seller, whatever is outstanding and left in that escrow account. So 3 ways of doing it, but just thinking in that direction. And Jeff, I hats off to you. What took us weeks to figure out, you did in a minute. So you're obviously very, very smart and very experienced. So hats off to you, my friend. Okay, and then you have a deal. So this is one of the things that happened to me personally, and it can happen to you guys as well. Ever have a deadlock between 2 attorneys? It kind of looks like this. Lawyers have been negotiating PSA for a long time. Back and forth has been prevalent with the emails, and my favorite, contract is no longer redlined, rather resembles the rainbow many times over. So in a situation like that, where the lawyers are just battling it out, what do we do? Do we get involved? Do we not? Do we switch lawyers? Do we just give it up? What happens? Any ideas? Okay, so this happened to me with another, I was doing a deal with another broker, a very, very talented broker. And we noticed that the attorneys were just chopping each other up. They were both lions, and we loved it. I mean, we each want the best for our clients, but we understood that the deal was just not going anywhere. So this was his idea. I'm not going to take credit for it because he mentioned this to me, and he said that we have to go back to the basics, the business terms of the deal, because the legal should complement the business terms and not the other way around. Sometimes we forget the business aspects of what we want to get accomplished, and we start dealing with little legal jargon and little legal, that word again, Jim, you got to help me out again. Nuances, there you go, I got it. The little legal nuances that are annoying. You got to go back to the basics. And I decided to meet that broker, and we sat together. His name was Zach, I forgot his last name. And we said, okay, what are we trying to accomplish here? What are the business terms of this deal? And we laid them all out. And then when we saw everything, we renegotiated all the business deals. And then we sent that back to the attorneys and said, get this, make this happen. This is what we each want. This is what we negotiated. We're businessmen. We know how to get a deal done. And the deal was done. And it was a lot of fun that we can see that happen. So that's that story. Always remember the business, the legal should complement the business terms and not the other way around. So that's for that section. Any questions? Okay, I mean, it's 3:45. I've taken up a lot of your guys' time. I can go on if you want. I can stop. Vinky, what do you think?
Yeah, I think this is very informative, and you can go on if you have a couple more nuggets for us. Then we can break out for the networking.
Okay, I'll do
2 minutes more.
So I was gonna speak about the BOV, the broker's opinion of value. Before speaking about the broker's opinion of value, which I doubt I will get to today, and I mean, we can touch upon it just in the basics, but I did create something kind of interesting that I wanted to share with you guys as a broker. So, and let's talk about it. Let's address the elephant in the room. I'm a broker. You guys are all probably multifamily real estate investors, and we have this thing going on. And why? What's this elephant in the room? So when I go to a potential investor and I say, what's your acquisition criteria? What do they tell me? Right? That's kind of like what I'm getting all the time. I don't want any listings. I only want off-market properties. And I always ask myself, why? What's happening here, and what is it about off-market that's so attractive, so lucrative, something that the investors as a whole, not every single investor, but a ton of investors would be willing to give up a great listing just because it's not off-market. So I kind of started with putting together off-market, going back in time in its purity, what it used to be and what it's become. So in its purity, an off-market deal would be something that's direct to seller. It is not actively being marketed on a public listing website, MLS, LoopNet, Crexi, CoStar, etc. Not actively email blasted to thousands of investors either. This is off-market, does not have a broker attached, which again goes back to direct to owner, and it's usually was a distressed asset, which means that the owner needs to sell this property. And this is where a deal happens, because if you have a seller that's distressed and he is getting foreclosed on, or he doesn't have money to pay back his loan, and you come in and you save him, that's a great off-market property because there is a deal to be had. You're telling him, I will save you, but you're going to need to give me a deal to save you because you're doing the seller a favor and not the other way around. And what it's become off-market today, it's become exclusive and lucrative listings that sometimes come with a markup. I know a lot of brokers that sell off-market properties much more expensive than marketed properties because they're off-market. It's become something very lucrative, and it makes the buyer feel like they're special. There's a whole secondary market of off-market properties that you guys don't even realize, because when someone sends you an off-market properties, you do not know how many people have seen this property unless you are direct to owner, and even then you don't know how many people he shared it with. If he's not distressed, if he's not having to sell the property, you should keep your eyes open and understand what kind of off-market this is, if it's a real off-market or if it's a fake off-market. And then I put some pros and cons. I will say I'm very biased when it comes to this because obviously I have listings. I have every interest to keep you guys interested in my pocket listings and listings. So I would love for all of you to share more pros and cons of what you guys feel. But I do feel that this reflects a lot of what's going on today. Pros of off-market: if it's a distressed asset, there is a below-market rate deal to be had. You're dealing directly with the owner. It can be a con. Most of the time it's fun because you know the owner directly and you're kind of getting this deal done directly with him. Potentially less competition, which is also great because less people know about off-market properties. Sometimes if it's not email blasted to 100,000 people and you feel like you're a special investor because you see this off-market property. The cons are, one, you are missing out on a lot of other deals. Now, I'm not saying every single marketed deal is amazing, but there are some owners who prefer to market the deal. They want to have that competition. They want to have that bidding war. They want to have those listings out there. If you're not looking at them, you're missing out on a major portion of your market and what's out there. Time and market are known for off-market properties. And that was going back to my joke, how long does it take a broker to sell an off-market property? Depends how long it's been on the market, right? So I can have a marketed property, didn't sell, I get it off the market, and then I sell it as an off-market property. Everyone's like, oh, this is amazing, this is incredible. You guys don't know, this has been on the market for maybe 500 days. I decided to take it off for 3 months and then put it back on. It's very difficult to understand the seller's commitment to sell as well. When there is an exclusive right to represent, you know this is a motivated seller. When somebody sells you an off-market property, he can just get your PSA agreement just so he can get some information out of you. He can go out to Jeff and say, hey, how much money do you want to give me for this off-market property? He'll say, I'll give you $3 million. Hey, Jeff, hey, Jim, how much would you give me? You'll say 4. And he's like, okay, I'll think about it. And he retracts. And that's it. There's no commitment at all. Unless, again, and this is where the original off-market property comes to play, it's a distressed asset. And you know that he needs to sell, but then the power is in the buyer's hand and not in the seller's hand. Again, it creates this allure that can fetch a higher price, which is completely counterintuitive to the idea of off-market, and unknown of how many eyes are seeing or have seen this property. Again, this is correct to marketed properties, but on marketed properties, you know that this is being marketed. You know many people are looking at this. Off-market, it's never really known what's happening behind the scenes. Going really fast on the BOV, A broker's opinion of value is an extensive presentation that we give to owners. Usually, sellers will ask multiple brokerages to put one together. We have an executive summary, property summary. We get a lot of information, and the valuation itself is based almost like how an appraiser would evaluate the property, the capitalized income analysis, comparable property analysis, replacement cost analysis. Going into those steps, I have a little stock market thing going on to celebrate I think we're like an all-time high in gains, and this is pretty great. So we closed an all-time high this Friday. So go to our stock market. Income and expects. So what we gather for the capitalized income analysis, we get the income and expenses, we get the market lease rate, we understand the cap rate analysis and comparisons, which is super important. Market trends and vacancy rate comparisons, we put those together to get a cap rate. Once we have a cap rate, we divide the cap rate by the NOI, we get the price. Comparable property analysis, basically influencing demand for that type of asset. We want to look at listing for several comparable properties in the area. Ideally, comps would be for similarly sized properties in similar condition with similar amenities and in the same market. The older the comps, the more absolute the data is. So you want to get things as recent as possible. And market competition, including other assets currently listed for sale. You want to get an idea of what people are looking for, what people are willing to buy, for how much people are willing to sell. And last but not least, the replacement cost analysis, we would get just the environmental data available, zoning information, market trends, construction costs, land value, improvements value, and get the idea. We put all of these three together. Where I always feel the capitalization approach is prevalent to the rest of them, comparables gives, because when we do the capitalization approach, we also use comps. So just strictly saying comps is not always the best indicator. We put the three together, we kind of get a price. Usually we give a range between this amount and that amount. And we also give a range of how much you would list it and how much you would sell. Going extremely fast into the BOV, that's kind of how it comes together. And that's it. Thank you very much. I appreciate your time. I appreciate you guys listening to me. I hope none of you fell asleep. And
no, we didn't. I think it was very informative, but I do have one question for you.
Yes, please.
You say you use the cost analysis approach most of the time, right? So what are the other scenarios when you use the other approaches like that?
You want to get an indication of all three. So if you have a huge discrepancy, if you're saying, okay, I'm looking at the capitalization approach, market properties are trading for a 4% cap rate because of the certain NOI and expenses that I'm seeing on the market and the taxes and everything that you're going at. But then I'm looking at comparable properties and they're selling and buying for much higher or much less, then I need to pay attention to this. What's going on? What's causing this? Is this a specific property? Now I'm looking at the comps and I want to look into those different properties and seeing their income, their capitalization, their vacancy rates, what's going on. That's why I really want to look at the market and see why is there such a difference. Another indicator would be the replacement value, looking at the land value and the improvements value. And of course, the improvements value is kind of difficult because you're kind of seeing how it would be today, the current value of the construction. And if you're in a market like today, construction is a lot more expensive than it would have been a few years ago. So there could be a little bit of a shift in that, but you want to have an indication of all three. When I always feel the most prevalent one as an investor would be the capitalization approach, because at the end of the day, you want to have cash flow. That's why you're buying this as an investment property. So I'm not buying this because I want to rebuild it. I'm not buying this because other investors are saying this is what properties are selling for. I want to buy this because this needs to be a good deal that makes sense for me as an investor and the type of mandate or the type of investment that I want to do. Does that make sense?
Yeah, it does. Thank you so much for sharing that. And anybody has any questions, please you can just take yourself off mute and ask the question. Any questions? Can you? I'm sorry, go ahead.
Yes, I have a quick question. So I had a situation just a couple of days ago that I was pressured to, they said that the call for offers was already closed, and then they're getting back to me, oh, we're reopening it for one more day. So, and I did not, when they told me it was already closed, I didn't even look at the self-storage facility, right, the property. And then I only had 1 day to figure all that out. So my question is really, the call for offers, right? Why it's sometimes getting extended, why it's so strict, could it be sometimes not strict? Can you talk a little bit more about that? what you experienced.
Yes, absolutely. And let me tell you a story that just happened to me with a client. We were looking at an industrial property. It was trading for $1.95 million. And the client, I know, cheap, right? For California, especially. So what a deal to be had. But the client said, we don't want to give that much money. We're willing to give him, I think it was maximum 1.5 million, and we'll close it at that. So we turned in a PSA agreement. We said, this is what we're willing to pay. And it was a lawyer representing the landlord, and he just started yelling at us and said, this is a trash offer. You guys are completely insulting me. This is crazy. This is insane. You guys should be ashamed of yourselves that you're kind of lowballing me like this. I threw your offer to the trash. Please never speak to me again. Hung up. You know, that's fine. We went on and we found another property. And this was about, I want to say, a month and a half ago. Oh, and he also mentioned, this is important to the story, he mentioned he has a bunch of other offers coming together. There's a bidding war on this property. And this is a joke compared to what other offers he got. We received an email today for a price reduction. And now he's selling it for 1.6. So when it comes to those things, it's a game. It's a wild game. And you need to have your comps in place. You need to know what kind of property and how much you're willing to pay for it. And when you know what your underwriting looks like and you're confident about it and you know how much a property is worth, no seller can be able to push you away from that unless it's worth it for you. But then again, that should be always in your underwriting. You should always know what's the maximum amount and what's the least amount. Well, least amount is, you know, get it for free. What's the maximum amount that you're willing to pay for a property? And as we like to say, the most powerful negotiating position is the ability to walk away. That is super powerful. And if you can walk away from a deal, you're in a very good place. And that's probably what happened in that deal. They said, call for offers. Nobody turned in an offer, and others saying, oh, we'll give you another day, which is funny because they might, if you would have turned in an offer and you would have lowballed it, they might have accepted it. The funny thing is he threw out our offer, but he made such a presentation. I think he's too ashamed to come back and say, let's accept your previous offer. He might want us to do another one, but I mean, we already found a different property, so not relevant.
Great. And just related questions. So what would be your suggestion right now? I think I spoke with my partners, like, let's do a bit more analysis since we have a couple of days, and maybe on Monday, submit another one that, because we did put it kind of low, not complete low ball, but it was almost at $1 million and we put like at 840. Yes.
So I'm not gonna lie to you. I mean, obviously there's a reason why people are not buying it. Do you guys know Mr. Bob? Mr. Bob, okay. So Mr. Bob is a very good friend of yours because anytime a property is on the market or is being sold and no one's buying it, you want to understand why people are not buying. So you always ask Mr. Bob. So the first, and we go by the letters. So Mr. Bob would be, the first thing you look at is the market. What's happening with the market? What are the rent absorptions? What are the vacancies look like? What are people coming in? Employment, demographics. Look at the market and understand what's happening. And again, I'm only talking about this because they had a property on the market. They asked for bids. Nobody gave the bids, so they extended the time frame. Why are people not buying this? So Mr. Bob will keep on going. Market looks good. You move on to the next one. Rents. So Mr. MR. The rents, what's happening with the rents in the property? Are they good? Are they bad? Are they under market, over market? Probably not over market, but how much are people willing to pay in that market? That's Mr. Bob would be, the next one would be the building itself. You want to check the building and understand what's going on with the physical aspects of it. Maybe there's a problem with the environmental. Maybe somebody came in, gave a bid, I mean, if you're saying 1 day later they gave an extension, I don't know if somebody had the time to go and have like an inspection or inspector.
No, it wasn't 1 day. It was actually about 5 days. I just kind of forgot about it, and then
it could be that they sent over information. They sent over environmentals. They checked out something, and it didn't check out. So they said, we want to drop out of this deal. They might have lost their earnest money, but they saved in the long run. So maybe someone, again, I don't know what happened. You can even call them and ask, hey, what's going on? Why did you say that you're closing? And now, I mean, usually people are good people, usually, and they might give you a very good answer. I've received incredibly good answers to why sellers want to sell their property. Extremely amazing. Like answers just make perfect sense. Because I would think to myself, why would you sell a property like this? And they give me a great answer. Sometimes it makes total sense. So going on with Mr. Bob, after the building, you want to look at the owner. Maybe the owner isn't motivated. Maybe the owner is being really adamant on a price. Maybe he's just difficult to work with. Maybe he's too good to work with. I don't know. Whatever's happening with the owner. And the last but not least, broker. If there's a broker involved, he might be giving a difficult time to people. Maybe he's telling the owner something. Maybe he suggested that they go back to market. Maybe he thought of something else. Maybe he wants a higher fee. Maybe something happened there. Usually brokers, I attest to myself with the least of the problem. So always go through Mr. Bob and figure out what's happening with the property. If everything checks out, then do the due diligence, scrutinize it. If it's a great deal, we can't be 100% skeptical. We can't have analysis paralysis. If it's a good deal, you did the due diligence, you did what you were supposed to do. A lender likes it, appraiser likes it. You got a second opinion, you called me and I liked it. I'm kidding. Go for it, you know?
Fantastic. Thank you.
Always remember Mr. Bob.
Yeah, I have it on my desk.
Oh yeah,
told me a long time ago.
It might have been me.
On my computer a long time ago. I have a question for you. This is just for fun. I wanted to ask this question. How
Please.
important it is to know the story behind any sale, you know? And I just wonder how much the truth is behind that story. It could be something, you know, more on the lines of the broker and the seller cooked up something to make it more interesting. So there's the interest from the buyer side. So can you give us a little bit scoop on that? How the story behind each property works? Like how much truth is there, or how relevant is it for the buyer?
Okay, I don't want to be biased again. I think when it comes to off-market properties, sky's the limit. Sky is the limit, because the owner has nothing to lose really. So he can say many things. And I will say this, more cases than not, a broker's reputation is on the line. So if I'm listing a property and it's pure crap because I made up this story, I'm going to have a very bad reputation and a very difficult time to sell properties. And this is relevant to everybody. I'm sure that every single one of you in the room, you want to have a good reputation. You don't want to sell a bad property, because the commercial real estate world specifically, it's a very small world. Now, can things cook up? Yeah, of course. And oftentimes the seller might not even know about it, which is super interesting. You can have a situation where they have an encumbrance, or they and they don't even know about it. They might have a claim deed on their property and they didn't even realize it. So many things can happen, and it's our job as buyers, or your job as buyers, to get that information and gather as much as possible. So if you want to give the seller the benefit of the doubt, always remind yourself that there could be things that he doesn't even, or she doesn't even know about.
Okay.
I had one question. I'm sorry. It's, you know, that was awesome. I appreciate you sharing about Mr. Bob. But let me ask you about Mr. Hard Money Day One. You know, what is your take on that, and how much weight does that hold?
Hard money day one, what do you mean? Like when you get a hard money loan?
No. When I'm sorry, when the earned money deposit goes hard day one.
Non-refundable, Shmuel.
Yeah, non-refundable.
Yeah.
How much weight does that hold on an acceptance of an LOI?
The amount that you're offering?
The offer, the total offer. So you know, there's
I mean, naturally a lot, because the more you're willing to give, the more serious you look. If I'm
Mhm.
telling an owner, I'll give you $5, I'm like, okay, he can pull out and there's nothing to it.
Mhm.
But if I say I'm really serious about this property, I really want it, I'll give you, 3%, 5% of the offering price.
Okay.
You're very serious about this buy. He's going to work with you. But again, before doing that, I do recommend knowing what you're doing, having a track record, understanding the market, working with an attorney, probably having an LOI. Again, the PSA is in a very competitive market situation when you want this property. You want it. Having an LOI ahead of time and discussing the legal or the business terms of the deal, because if you don't decide on a price even, and you just give over the PSA, and then again, PSAs are negotiable before you open escrow. You don't have to sign the PSA, the purchase and sale agreement, so you can change the earnest money amount as well. I was going to mention something else when it comes to that. But hey, I mean, I want to throw this out to the room because I'm sure tons of you guys have experience in that. Jim, what do you think?
Well, I was going to ask you if you see any softening in the market. We're still seeing, regardless of what's going on with the greater economies, that most, even tertiary markets, are still extremely competitive for multifamily if you're dealing with anything above 50 units. Now, when you get below 50 units, it's a whole new game. And I think that, there's a lot of things that can be thrown out, so it really depends on what you're looking at. But unfortunately, we're seeing people that have relationships with brokers that it's very hard for you if you've not done a deal, or if you've only done one or two deals. It's very, very hard to win a deal. You have to really understand what the motivation is for the broker. And one of the things that you can do is you can overpay, pay more than anyone else. And that's a relative term. If you're still making money, did you overpay? I don't know, and how many investors and who's investing alongside you. I tell people all the time, I think that the best way to get started in this business is to start small and grow exponentially. And if you're starting small with a 4-unit, 5-unit deal, and I really think 4 units is where you should start for 90% of people, it's very difficult for you to overpay. If you overpay by 10% on a $400,000 property, you've only got to make up $40,000. And if you're holding it for 5 years, that's going to be easy to do. But if you overpay on a $10 million property, you've got $1 million to overcome. And that's a lot harder to do. And if you're going to make mistakes, they're going to be exponentially larger with that larger property. But I, unfortunately, have seen some friends of mine that have a lot of money and they don't want to overpay for the property. And everyone knows that they can close. Everyone knows they did 10 deals last year, and they're putting down $1 million hard day one on a property. And if it's a $10 million property, they know they're going to have to put the money in there anyway. They're very, very certain of the market. They own several of their properties in the market, and they know their underwriting is accurate. And they've done probably some preliminary due diligence before they even made the offer, before they put in an LOI. And when they did their walkthrough, they took people with them to perform more due diligence during the walkthrough. And most of us are not doing that. So they can afford to put $1 million hard, and you have no way of competing with that. And so, I think that there is a lot of weight put on that. And if you don't have $1 million hard to put down, and I'm not trying to say that this is happening in all the markets, but it is happening in some of these really hot markets where people used to put down 1% or 2%, and maybe now they're putting down 5% to try to win the deal. And, I'm hoping that the market turns and this will go away. But even if it does, it's always going to be a way for another tool in your toolbox for you to win a deal. And I don't like it, but it is what it is, you know, but you better be certain. You guys all know my story. You all know what happened to me last year. And so you've got to be certain, and you've got to be able to lose it.
Can you put your contact information? So how can everybody reach you?
Oh yeah, of course, anytime. I love telling jokes. So if you guys want to hear a good joke, just reach
Yeah, I
out.
would love that. Yeah, share one of those that you were telling Jim earlier.
Oh, I think I said one of them. The other one was landlord. You're tired of getting cold called? I have a solution. Sell your property. Yeah, I love that. Okay, this is my name, phone number, email, and my name is the same in all social media networks. So if you look me up, Facebook, LinkedIn, Instagram.
Nice. So I'm going to repeat that. So if you have any questions, you can reach directly to Shumul Siegel. His number is 818-919-2321. And also his email address is Shumul, SHMUEL @csncommercial.com.